In the ocean of information that is provided to us, we get so confused about that. We look at it, we come back, and we are not able to decipher anything. What are the basics of personal finances? Simple, right? Instead of those 600,000 elements, I just classified into 6 buckets, 6 elements. Increase cash flow. We only get a W2 paycheck. Of course, we can get 1099, we have C1, K1, etc. for our paychecks, right? For our livelihood. So how can we increase cash flow? How can we manage our debt, right? We have some debt. We have home loans, we have car loans, we have so many debts. How can we manage? How can we consolidate? How can we keep some emergency fund for emergency requirement? Then the other 3 aspects are proper protection. How can we protect ourselves against loss of income? And then the last 2 topics are build wealth and preserve wealth, right? If I'm alive, working very hard, am I actually building wealth and preserving wealth for my future, for my retirement, for my leaving a legacy for my kids? If I look at my paycheck, I ask myself, what is my biggest expense from my paycheck? Most of the time I get answered that mortgage is my biggest expense, or kids' education is my second biggest expense. That's probably not right. My biggest expense is a federal tax. And then the second biggest is a state tax, especially you guys in California, right? Then property tax, then sales tax, so many taxes, right? And then comes the mortgage, the kids' education, shopping, home insurance, blah, 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 right? So the taxes take away 45 to 50% from my paycheck. That's bizarre, right? We don't realize that. We all know that if we have a job, I've got a W2. Uncle Sam deducts the tax from it. Can I save taxes? Possibly, if I know, yes. If I don't know, no. Second bucket is tax later, which is nothing but we take out some money from our paycheck. 401k is the classic example, and all the IRAs except Roth, SEP, again for business people and stuff like that, and simple IRA. These are all money that we take out from your pre-tax money, put it in the vehicle, and then say it's taxed later. It's not tax deferred. We are not able to defer or exempt from the taxes. We have to pay taxes later. Many a times people come and ask me, do I have to pay taxes when I withdraw from my 401k at my retirement? The answer is a big yes, capital YES. We all have to pay taxes from our 401k withdrawal after 59.5. And if it is before 59.5, you have to pay 10% penalty. And if it is after 70.5, you have to pay 50% penalty, 50. Third bucket is a tax advantage bucket. I want all of you to take a quick note of this bucket. It's nothing but Roth IRA. It is funded through your tax-paid money, municipal bond, HSA 7702. Taxes are never going to come down if we are under the impression that, hey, 15 years later, I'm going to retire, taxes are going to come down. Sorry, that's not the case. Are we putting some dollars in the 7702 or tax advantage bucket? How are your tax dollars diversified? Now I'm going to talk about a little bit of how my investment diversification I have done for myself in order to manage my taxes best. Right? In the beginning slide, I said, we need to keep emergency fund, right? Of course, we need to have some fixed amount in our savings, account. And that's fixed, right? That's growth is very, very less. You see 0.5%, 0.75%, right? We need to still keep it. Another investment vehicle, it can be a stock, it can be a 401k, that the growth is, it goes up, comes down, goes up, comes down, goes up, comes down. So from a period starting here to here, your growth is this much. Because over the years, and we all know this is fact, how many times we have seen recession, how many times we have seen downturn in the market. So that's how the variable product works in the market. Index strategy. In index strategy, when the market is going up, it is also going up. When the market is going down, it locks itself at that same level. And then market is going up again, it goes up again. And then market is going down, it locks again down. That means, very simple, it does not participate in the down market. This is a vehicle, this is a strategy that does not participate in the down market. It is also called a principal protection program. That means your principal is always intact in this strategy. Again, take a note that all three are good. All three, we must have all three type of investment strategies. It's just that the diversification I'm talking about. You have to keep some money in your bank. You have to put your money in the 401k. You must put something in your index portfolio also. A stock versus an index strategy product. Somebody starts with 100,000 investment. At the end of 21 years, his yield is 13.08%, takes him to 387,000. Because there's so many times this has been negative, right? 119 becomes 107, 107 becomes 93, etc. Whereas in the index, whenever there is a negative, that means the downturn, it locks itself down. So it's 0%. You are protecting your principal plus growth. So your principal grows to 112. It locks itself down to 112. And then when again the market is picking up, it again picks up from 112, not from the down market value. And hence, after 21 years, the yield is 17.88%, almost 18%, to 493K, $500,000, almost. How money works in the two scenarios. So say the first scenario is the first table from column 1 to 6, and the second scenario is the index universal life from column 7 through 11. Now, here, from an apple-to-apple comparison perspective, the investment is simple, $1,000 per month, which is $12,000 a year in both the cases. And just again, apple-to-apple comparison perspective, it goes up to, from a 40-year-old male, when he starts investment, it goes up to 64, means about 25 years of investment. Same here, 40 year goes up to 25, another 25 years when he reaches 64. And then 65 onwards, if you see minutely, I'm sorry if it is too small for you guys, but 65th year onwards, I am pulling out money from this vehicle. Almost 75K per year. And then in order to do an apple-to-apple comparison, I am also pulling out the same money from my 401k investment. And hence, now you see the magic, what happens. What happens? After a few years, it vanishes. The 401k principal plus growth vanishes. And then from 78 year onwards, it's all zero. Whereas in the index universal, it continues till you're alive. That's how the vehicle is structured. That's where we specialize in guiding you, telling you where to put, how much to put, and etc. Per year investment in both the vehicle, 12,000 here, 12,000 here, 25 years of investment, 26th years onwards, I'm pulling out 75K every year from both the vehicles, and this vanishes in 12 years. This never vanishes. One more thing, this money is tax-free money, whereas this money is not. Because in the beginning I mentioned 401k, when you withdraw, you will have to pay taxes. this is tax-free money, because this is the nature. The question may be in your mind, why this is tax-free? Because of the nature of the investment vehicle, it's tax-free. Back of the envelope, I need my money to grow, save, grow, safety. That means we don't lose any. So losing money is not an option. Liquidity, whenever I need money, I should be able to pull out. Tax deferred growth, can I do that? Possibly, answer is yes. And lifetime income, whether my investment today generates a lifetime income when I retire. This is all long-term planning. So first column is 401k stocks. Perfect. 3 out of 5. I can't expect more than this. Real estate, 2 out of 5. We all know that grows. It gives you tax deferred growth. Fixed income concept, again the same 7702 that I spoke about. It gives all 5. Can we put some money here? Possibly, yes. Will I pay any taxes during retirement? If we don't do it well, yes, a lot of money will go into taxes during the retirement. Many people told me that, hey, you know what? We're going to be husband and wife at that point in time. Kids are all gone to college and job and etc. My home is paid off. How do you think my expenses are just $10,000 or maybe $8,000? Expenses are going to rise. You are not going to let go your current style of living. Even you're going to spend more, looks like, because you're going to do vacation more, you're going to buy another property and stuff like that. Probably you're going to spend more at that point in time, and taxes will be even higher. So if we don't plan it today right in a right way, we're going to spend more money that time. Can I have a control over what Uncle Sam does? Possibly not. But can I manage those taxes by doing diversification in investment? Yes. That's a big yes. How does market risk affect my requirement? Is losing money an option? No, it's not an option. So market, why should I lose money in market fluctuation, market risk? And then the last one, how much do I need in retirement? And again, people say that I'm not going to need more than $8,000. Husband and wife, 2 times, that's it. And we're going to retire happily. So retirement is not a gamble, guys. My point is, be certain in uncertain times. If we are deferring taxes today on a smaller amount, the amount is going to grow after 20 years. So let's say if we are saving taxes on $100 today, the $100 will become $200 tomorrow. So we're going to pay taxes at that point in time, right? So we call it whether we pay taxes on a seed or a harvest. A smart person will pay taxes on seed rather than the harvest itself, where Uncle Sam comes in and say, pay taxes on the entire $200 rather than when you deferred your taxes was on $100. What is the smart choice? Of course, pay taxes on the seed, not on the harvest. Those are the things we guide you. We make you know the inside out of the tax diversification and investment diversification.